Well, let's get more on this with Michael Amey. He oversees UK fixed income for Pimco in London. Do you really see it as a buying opportunity, or is it just very selective in terms of what you're looking at?
No. So we think that the volatility at the moment is indicative of the private sector debt crisis following on to the public sector. Ultimately, we see volatility across the peripheral European countries. We think there will be volatility in the UK bond market as well, which the market is underestimating. So when we look around, we look at markets with high levels of debt. We look at the problems they have, and we see volatility, which of course as an active manager does create opportunities. But we wouldn't argue that at this stage we're in an obvious buying opportunity now.
All right. Well, if we look at what's happening with gilts, what is the follow-through from what we've seen already from S&P and how they've behaved towards Greece, Spain and Portugal?
So the UK is an interesting position because the UK's problems are clearly slightly different to the peripherals. The peripherals sit within a fixed exchange rate regime. They don't have their own currency. So when we look across to the UK has similar levels of debt, similar fiscal position. We have better starting position than many of the peripheral Europeans. So the UK has a bit more breathing space than Greece and Portugal in particular. But the fact of the matter is we do have high levels of debt, and it is a problem.
So, you know, how important is the election in resolving all this as well and getting rid of that volatility and a hung parliament with that uncertainty in prospect? How much does it make things worse?
Well, we think the markets are underestimating the volatility that we could see around a hung parliament. We think that the markets are looking through the hung parliament and saying to themselves, well, you know, the depths of the problems in the UK are sufficiently large that even in the event of a hung parliament, the parties would come together to tackle the fiscal position. And to be honest with you, we're a little bit more sceptical that you'll get that political union straight after the May elections. So we would see a hung parliament as being.
Could it also invoke the ire of the ratings agencies?
Sure, the rating agencies will look at how the new government behaves, and the rating agencies have made it perfectly clear that they're looking for further measures after the next election to retain the AAA rating. So yes.
Okay, so what happens, let's go through each scenario here. If we get a majority for one of the parties here, let's say it's a Tory majority, what happens then for the gilt market?
Okay, so the markets would like a Tory majority because the Tories are seen as those with the most aggressive fiscal plans. And of course, as a fixed-rate bond investor, what you're looking for is debt sustainability and credibility on the deficit. So the party that has the most aggressive fiscal plans as a fixed-rate bond investor is the one that one finds most appealing. That said, frankly, any majority any party that gets a working majority that is willing to tackle a deficit will be fine.
Michael, we've got to leave things there, I'm afraid, but thank you so much for joining us. Michael Amey there from Pimco.